Okay, so this is it. Hello, everyone. Spicy research here today. So I'm Guillaume. I'm here with Nathan Burks from the Panoptic research team. Today we'll talk about Volga mechanics on Panoptic. So this is Beyond the Greeks, which is our weekly research live stream where Nathan, Amy, Brendan, and I all go through some research topics that we found interesting, mostly related to options, but also sometimes with market structure. The goal is to kind of demystify maybe or present some high level research to the broader audience, something that you don't see quite often. So Nathan here has prepared a very cool one. I haven't seen it. Volga is not one of the Greeks that I look often, but I'm sure it's going to get some pretty good insights. So yeah, how are you doing today, Nathan?
All right, all right. Um, Definitely warming up a lot here in West Virginia.
It is the whole heat wave. A lot of folks are at permissionless, I think. So our team, Izzy
Yeah,
is there and Rosalie, and I would not walk around or at least spend 1 minute on the New York City pavement. It's
I was gonna say, yeah, the New York asphalt, that must be fun to walk around on barefoot right now.
I know. And then again, you hope your hotel is close to the main event, but if you have to take a subway, even oh my god, this is horrible. But it is what it is. The markets, the options world never stops. So yeah, maybe can you introduce briefly? Yeah, what you're going to talk about, and then yeah, I'll hand it off to you for the.
Yeah, Volga or real, it's a second order Greek and it really is representative of vol within options, so the volatility of implied volatility. And just looking at how it manifests itself through the prism of and options. Because in TradFi, as I'll go into in a second, it's a little easier to pinpoint
Because
for some reason.
TradFi, people may be aware of the VIX index, which is kind of a volatility measure. It's based off of the options pricing, but this is an index that people can trade. I think there is a vol on vol index, or am I
There
mistaken?
is. You beat me to it. That's on my title slide. That's
Okay.
why. That's why I was going to say it's a little easier to gauge in TradFi.
And what's the ticker for that, actually?
The VVIX.
Okay, because I feel like I understand a bit the dynamics of the VIX, of volatility, some level of support. Like it's almost like again a commodity where you don't have 0% IV, it makes no sense, and you don't have 10,000% IV, it makes no sense. So it's range bound. It has some move, but it's quite easy to understand. Vol and vol. If you don't, I'll share my screen for 1 second just to go on the VVIX for those that may or may not know about it. But
Oh yeah.
this one is a bit weird. I would expect that corresponds to the spikes we see. Um, so this is a future. So I don't know if there's options on those, but you could probably
Well,
take,
it's
yeah.
options on the VIX, so or options on VIX futures. That's how the pricing for this is synthesized. So similar to how the VIX is synthesized from options on the S&P or volatilities from options on the S&P. This is just that next step, but we don't have that in crypto
Yeah.
yet.
Yeah, we talk about the EVIV and the Volmex index, but yeah, this is interesting. I would imagine that the um, a similar index could be built in Panoptic, but yeah, we'll
Yeah,
see.
well, that's what I've talked about before. Like if you want to trade options on DVol or Volmex's indices, yeah, something similar could be built out.
Maybe yeah. So again, at the end of the day, if options are for risk management, therefore maybe kind of balancing and then maybe pushing the risk on the outside. People can trade the VIX or maybe the I mean even the volatility futures to hedge, but yeah, volatility on vol. It's to neutralize Volga, I guess. You'll talk about this. Let me stop talking and have you
Yeah,
take control. But yeah,
yeah, well, you beat me to it. That's the title slide. But yeah, it shows the just the progression of the VIX and the VVIX over time. And really, like, the title of my presentation is Harvest the Vol Risk Premium, because with that added volatility, there's an embedded risk premium that investors or traders perceive that you can take advantage of. So that's where, like, there's an overpricing with vol risk, plenty of times. So that's what I'm gonna be getting into today. But first, like I mentioned, Volga, which is really a short it's really shorthand for volatility gamma. So we see convexity with we've already mentioned price convexity in several articles with gamma scalping, reverse gamma scalping. This is actually a similar process, but just with implied volatility or vega. So really what it is in technical terms, Volga or Voma, depending on how you want to define it, is the change in vega with respect to changes in implied volatility. So it's a higher order Greek, twice differentiated with volatility. And it's at the highest for approximately 10 delta options. So it's at the highest in the wings. So to really gauge it, like, you don't have a standard index in crypto like we were just alluding to with, say, the VVIX. So how do you attempt to gauge it? It's really through a strategy called an iron butterfly, which is, if you want to go long Volga, you would long OTM wings, so you'd long OTM 10 delta wings and then short a straddle, a 50 delta straddle. But if you wanted to go short Volga and short that risk premium, that vol risk premium, you would do the opposite. You'd long the straddle, short the wings. So my inclination going into this was, we already have, as you can see in one of our prior presentations, there's already a doom loop built in to where, like, LP positions are intrinsically short gamma. So there's an intrinsic short gamma bias. I was wondering if the same thing or the same property presented itself through short Volga. So my inclination was to try a reverse iron butterfly, which is what I just described, with being the long straddle, short the wings, and this is what I found. Now this is over a 4-year sample. These are the 4 separate legs. But what you see when you compile all these returns up is that it's approximately a 59% return over the span of just over 4 years, um, which amounts to about 12% annualized. So this is steady. That's relatively steady yield for just putting on a short straddle or a long straddle, excuse me, and short wings for a span of 4 years and just maintaining that position. So, like I said, a reverse iron butterfly, short Volga, iron butterfly, long Volga. Now, but granted, this is a longer term trade. Like, harkening back to the spot vol presentation we did last time of the Vanna trade, that's much more concentrated and ephemeral, where you really want to take advantage situationally of changes in the spot ball correlation and harvest it for, like, the span of a month. This is over a span of 4 years, and it just steadily accrues returns. And really, if you look at it, the main contributing legs are the 50 delta long call and the 10 delta short put. So inherently bullish positions. So I found that to be interesting as well. So, like I said, there's an inherent short gamma bias via Uniswap. There seems to be an inherent short Volga bias as well. Um, Going to the next one though, which we ran on BTC, the returns were much lower. So 17% total. Once again, the same bullish legs contribute the short put and the long call, but that only amounts to about 4% annualized through just over 4 years, May of 2021 through May of 2025. So this begs the question, why is this the case? Like, not just like, why is there such a disparity between BTC and ETH, but also why is this a much longer term trade? Akin to reverse gamma scalping, whereas like spot vault, like you have to concentrate it over a long span of time, whereas for example, the spot vol or Vanna trade is much more akin to gamma scalping, where it's more protracted. And to me, the answer lies in the um, IV vol vol correlation. So you see, like, based on these graphics, that like I took the rolling vol vol for both ETH and BTC and the rolling correlation between the IV is in our Uniswap IV measure and the vol itself. And if you look at the ETH correlation, there's much more deviation around the mean. Whereas with BTC, not as much. So there's more to fade or mean revert, hence where that risk premium comes into play. So does that make sense? And you can tell just visually that the overall correlation is higher because like look at early 2024 as an example. The spike in IV and vol correlation directly corresponds with an increase in the vol itself.
No, yeah, this is very interesting, and a lot of the so these back tests are very mechanical, right? Like whatever the market, you kind of do the same trade. So there is also maybe a way to capitalize on some of these events because say 2023, 2024, the dynamics were
Mm.
a bit less interesting, and then you do have these spikes, which is where you have maybe a bit more opportunities for profits. But yeah, this is actually very interesting. I've never seen IV to vol on vol correlations shown this way. This is actually pretty cool.
Yeah, yeah. Well, it's just trying to devise technical indicators to know when or how to deploy these trades. And really, like I said, if there's a higher IV to vol correlation, the market is going to price in inherently higher volatility risk. So there's more to mean revert. There's a higher risk premium, like we alluded to with volatility risk premia in the wings with prior presentations. And like bear this out versus other asset classes, like the overall correlation for our sample, the sample I just showed you was 0.51 for ETH, which is pretty high. The BTC was 0.35, but the S&P, so VIX to VVIX, is 0.27. So, and just to see where that bears out, like shorter or short Volga versus long Volga, if you look at the two charts below, the one on the left, the black line, which stands for the BWB, stands for betting with butterfly. That's like if you were to uh, long stocks with high iron butterfly returns and short stocks with low negative or low butterfly returns, that's what that portfolio would get you. So about 4% alpha a year over the standard market baseline. So as you can see, the lower correlation, lower risk premium, it's more incentive to take the opposite side of the trade and be long Volga as opposed to short Volga.
And
Whereas the figure on the right, it's the exact same trade that we ran, except with the British pound and the over a number of years, and the cumulative return is negative. So I don't know what the overall IV to vol-vol correlation is, like movements in IV to vol-vol, but I imagine it's low as well. So really what it is, to me, is the indicator is, okay, you have a higher vol-vol correlation to IV. You have a higher vol-vol risk premium. You can then fade or bet on mean reversion with that risk premium. Similar to like short Volga trading is very similar mechanically to reverse gamma scalping in that way, and it's a longer term trade in that way. And you can harvest the returns in the interim.
And I'd say that the reverse gamma scalping is only straddles, right? So you have
Yes,
a
yeah.
lot more risks, and then
Once again,
yeah,
yeah, going back a few slides to volatility gamma versus just vanilla gamma, I guess. Like exactly, reverse gamma scalping, you short a straddle, and then it's your negative convexity, negative price convexity, or short price convexity. Here, you're short volatility convexity or vega convexity. So there's an added layer to it that you have to trade.
yeah, but yeah,
Um,
and if you do just the pure kind of reverse gamma scalping, you earn more fees, but you have more risks of large losses. If you do this, the Volga trade, you cap your risk. You have the iron butterfly. You know the most you can lose, the most you can win. It's actually a fairly less risky. I'm still impressed. It still nets out like 10% plus per year because it's a low risk, I'd say, because of the capped payoff that is maybe not fully juiced out, or at least S&P, you probably have dozens, if not hundreds of funds trying to do a similar variation of this. EAT probably has none of that, so the market is still quite nascent in terms of its ability to be efficient.
Yeah, that might be a factor as well in terms of the nascency of the market. These forces haven't invaded yet, but it shows there's a clear differentiation between this and more standard asset classes, whereas other asset classes taking the other side of the trade is more profitable.
And yeah, and even if you look at the S&P, maybe a clear like P&L, if you tune the strategy, pounds, again, if you look at flatness in pounds, maybe this is what you want. Maybe you don't want to make money on the pounds because it goes up and down. And then again, this is a good way to also to preserve some of that. So I would imagine that if the pound price or the P&L of that trade is negative, it probably means that you have maybe less risk somewhere else. So it's a type of trade, I'd say, that is intrinsically built for kind of that, not arbitrage, but kind of finding some alpha in the structure of the
Yes,
market.
yeah, exactly, some steady alpha.
Yep.
Um, but that leads me to like my next point, like potentially, or this could be unique to Panoptic from the standpoint, like the above is the P&L for a short Volga trade, so the reverse iron butterfly, whereas the bottom is the P&L for reverse gamma scalping. And you see there's an added, like, you see the sigma for ATM option squared, I guess, to account for the body. So there's an added dimension that you don't get in, say, reverse gamma scalping. But just transplant like Vega times the implied vol minus realized vol. This is Volga times the implied vol parameter squared minus the realized vol squared. So it's just fading that realized measure. And I'm wondering, does this create, maybe not on other platforms like Deribit, but but for similar to the Uniswap doom loop, well, the Uniswap doom loop is just slated one way to the downside because LPing is shorting a perpetual put option. Here, I'm wondering, okay, if there's an intrinsic bias to being short vol over a longer period of time, the way you hedge that is if, like, say, implied volatility rises, you buy more options to Vega hedge, whereas implied volatility falls, you sell off options. So it's similar to reverse gamma scalping in the sense, like with reverse gamma scalping, price rises, you buy more of the underlying. Price falls, you sell more of the underlying. You just transplant that logic to options. So I'm wondering if it creates somewhat of a feedback loop with our implied vol, our Uniswap implied vol, which is very different from, say, the implied vol you see on Deribit. So what you could see if implied vol rises, as we see more flows and volumes, you could see that trade flip, and be more like these established asset classes. Or you could see it be bolstered and create this reflexive feedback loop, whereas reflexivity is all based on like prices giving high prices giving way to higher prices, low prices giving way to lower prices. You see that with our implied vol. Like higher vol gives way to higher implied vol and vice versa on the low end. But as I was saying, I'm wondering if this is conducive only to Panoptic or on Deribit as well.
I mean, I think the way that we do trading of options on Panoptic, the way that volatility is kind of calculated, is based on these Uniswap LP positions, but also on the
Mm,
liquidity distribution in kind of Uniswap pool. So as you say, if the vol increases, it's because now a bunch of liquidity is out of range, and you can think of buying options as removing the old liquidity, selling an option, moving it closer to the range to kind of re-equilibrate that chart. So we're still pretty early, but I imagine as we move forward, a lot of these uh, volatility, Volga, vol and vol, all based of okay, what's liquidity doing? Is it going to be still and out, or you move it, you buy some of the wings, you move it closer by saying straddle, or you do the reverse. Too
mm.
much liquidity, you buy this the guts if you want, sell the wings to kind of hedge on that volatility expansion. So yeah, I think the but yeah
So
the
you do what like you I mean it you're inclined to wonder if like we've already established LPing short gamma, well, does that extend over to being short volatility gamma as well? And
yeah
we're just expressing that now on Panoptic because you wouldn't be able to make a trade like this on just Uniswap per se. Um, and it bears out mechanically from the standpoint of this being a longer term trade, like akin to reverse gamma scalping, and you're betting on mean reversion, yet the hedging for it accentuates the moves you're hoping to dampen. Whereas like spot vol or Havana, as we've shown on Panoptic, is akin to gamma scalping, conventional gamma scalping, in the sense that it's very fleeting. So and you have to capture it over a very pressurized amount of time. So it's really just trying to define these indicators and dig deeper and seeing, okay, is this differentiated only to with respect to Panoptic, this unique trait, and yeah, hopefully being able to capture this in a steady fashion because I mean, everyone's searching for yield. There's an everlasting search for yield. Um, and these unique properties are really important to dive into because if there's free money, you're obviously going to be willing to take it.
exactly. And yeah, and
So,
then it goes beyond just kind of setting one option. Now it's buying. You can even imagine having different widths, different kind of time scale. So yeah, overall, we're trying to kind of highlight a little bit, not necessarily the complexity, but the depth of trading that exists within the options world. We don't just bet on the price, which is quite hard to do sustainably. If you
yeah,
sell options, you're betting on the vol, but now even beyond that, you can also bet on the vol and vol, which is kind of a meta layer of,
exactly.
of yield. But yeah,
Well, and you could I mean, and this is another way to look at it. Like you look at distributional moments, like a straddle, for example, would be equated to variance trading variance. A risk reversal, the spot vol we were talking about last time, could be equatable to trading skewness, whereas this could be equatable to trading kurtosis. So second, third, and fourth moments. So um, you could. That's the beauty of options in a way. It's like that. That's not something you're going to get through just delta one trading in perps, for example.
Yes, definitely. So, but yeah, this is again without dunking on perps. Yes, I love
Yeah,
the
yeah.
richness.
Sorry, I
No,
didn't mean to cause controversy.
that's fine. I love the richness, and it does definitely have a what may seem like a steep learning curve. This show today was a bit more advanced for the regular user. We do the trading shows with Rosalie where we talk about the basic mechanics. But yeah, this is actually very. I love this. This is a good piece for sure.
Okay, well that's it on my end for
Okay,
the
perfect.
presentation.
Yeah, so I think that's it, and then we'll try to do it. Yeah, on the half hour mark. This was great. Again, this is a demonstration of the multiple layers. Second volatility, second order Greeks in this case is you trade the volatility, but vol and vol is like same strategy almost, but applied to vol as opposed to
Mm.
applied to the price. It has some intrinsic. Yeah, I'm actually surprised. It has some intrinsic uh, yield opportunities that again haven't been exploited fully.
Yeah, and once again, that's the art of it. Like we can go into the science of it with the back testing, but seeing okay, Volga is similar to reverse gamma scalping on Panoptic, where Vanna or trading Vanna is similar to gamma scalping over a more narrow time frame. Those eventually we hope to devise certain concrete technical indicators, but there's a lot of guesswork and intuitive reasoning that goes into it beforehand.
Yeah,
So hopefully this bears out in future research to where we can say, hey, this is a defined like Bollinger Bands
and yeah,
in technical analysis, something along those lines.
exactly. And to some extent, you can probably say, okay, let's study buying these iron butterflies, saying they're iron butterflies, we do some best testing, but now we can say, hey, this is actually Volga trading. So the each trade that you construct to some extent has a menu of Greeks in front of it. Which one do you optimize? Which one
Yes,
do you
e-
optimize for? When to go up, down, and that's kind of the link between.
exactly. It's more a la carte that way. There's a full menu.
Exactly. You're making me hungry. This is great.
Yeah,
Thanks a lot, Nathan. A great piece. Again, Volga mechanics. You don't hear about this often. Certainly not on Twitter. But overall, this was great. Happy that we got to go through that. So yeah, thanks a lot, Nathan. Um,
thank you.
on that note, let's do the outro for half a second, and then I'll be on my way. This is great.